Realty Income has become a controversial REIT in recent years. On one hand, you have investors who are very bullish on the company because it has an amazing track record and is currently offered at a historically low valuation and high dividend yield. But on the other hand, you have increasingly many investors pointing out to the growing risks facing the company. Its huge size is slowing down its growth, its portfolio quality has degraded in recent years, and the recent surge in interest rates is also slowing down its growth even further. Upfront disclaimer here, I've been in the second camp in recent years and have posted many videos on my channel explaining why Realty Income isn't the best pick in the net lease sector. At High Yield Landlord, which is my REIT newsletter, we have favored one of its close peers called Essential Properties Realty Trust. This has been our biggest net lease investment in recent years and it has done far better ever since it went public. But what about today? In today's video, we're going to take a fresh look at the company's Q4 results as well as its guidance for 2025. We're going to discuss the good, the bad, and the ugly. And at the end of this video, I'm going to give you my latest rating for Realty Income. Hey, this is Jussi. I run a small investment firm that specializes in REIT investing. And before going into today's video, I want to remind you that we'll soon conduct several REIT CEO interviews for High Yield Landlord, which is my REIT newsletter. Some of these interviews will be completely free, so make sure to subscribe using the first link in the description of this video. Okay, so let's get back to Realty Income. I'm going to start by discussing the good part of its latest results. The good news is that the company delivered strong full-year results with its AFFO per share growing by nearly 5%. This is a very attractive growth rate for net lease REIT, especially in today's challenging environment. It's all that's needed to reach double-digit total returns when your stock is already offering a 5.5% dividend yield. So it's fair to say that 2024 was a very good year for Realty Income. Another piece of good news is that Realty Income recently closed a major sale and leaseback transaction with 7-Eleven, and as a result, it has now become its biggest tenant, representing nearly 4% of its rental income. I think that this is good news and should help its market sentiment because until now its biggest tenant was Walgreens, which is facing severe challenges. 7-Eleven is just a better company to have at the top of your tenant list. Okay, so that was the good news. The bad news is that the growth is now slowing down. 2024 enjoyed the one-time bump from the Spirit Realty Capital buyout and also some other one-time factors such as lease termination fees, which will not continue going into 2025. This is really what allowed the REIT to grow so fast in 2024. But this rapid growth is now coming to an end as the REIT has guided to grow its FFO per share by just 1.4% in 2025. That's a far lower growth rate than that of its close peers like Essential Properties Realty Trust and Agro Realty, which we have often compared to Realty Income on this YouTube channel. It's actually an even lower growth rate than that of some of its lower quality net lease peers like EPRT Properties. So it's fair to say that its 2025 guidance is rather disappointing. And so here you need to ask yourself, why is Realty Income growing so much slower than its close peers? And we think that there are really two main reasons for it. And we can here compare Realty Income to Agro Realty. And the first reason is its size. Realty Income is about 8 times bigger than Agro Realty. It makes it a lot harder to grow because each new acquisition will have a smaller impact on its bottom line. Size is the enemy of growth. The second reason is the size of its spreads. Realty Income's cost of capital is today quite a bit higher than that of Agro Realty because its equity multiple is a lot lower and so its cost of equity is higher, yet they're buying properties at roughly the same cap rate of around 7 to 8%, closer to 7% in most cases. And so since Realty Income has smaller spreads and it's bigger in size, naturally it's going to have a much harder time to grow externally. Unfortunately for Realty Income, the size issue cannot be easily resolved and the spreads are mostly out of its control as it depends on how the market is valuing its equity. So now we've discussed the good, the bad, let's now look at the ugly. The worst news from the latest earnings result, in my opinion, is that the company guided for 75 basis points of bad debt in 2025, which is far more than what we're used to from Realty Income. An analyst on the earnings call pointed out that in recent years it has typically been closer to 30 basis points. This significant jump in bad debt seems to confirm our fears that Realty Income's portfolio quality has deteriorated in recent years following its many acquisitions of lower quality REITs. We have already previously covered this topic in several articles at High Yield Landlord. Here's what I wrote in late 2024. I believe that this reaffirms my previous point that Realty Income's portfolio quality has degraded over the past years following their many M&A deals acquiring lower quality net lease REITs like VICI, Spirit Realty Capital, This is also evident if you compare Realty Income's occupancy rate to that of its close peers. It's today among the lowest in the net lease peer group and could drop even lower in the coming years if it faces more tenant difficulties. And I'll put a table on the screen again where you'll see its occupancy rate compared to that of VICI Properties, Agri Realty, and then REIT, Essential Properties Realty Trust. And you'll see that while it's still very high, net lease REITs always operate with very high occupancy rates because of their long lease terms. You'll see that it has dropped quite a bit lower than that of its close peers. It's not in the 99s anymore, it's in 98 point something, 0.7 if I remember right, which again is a high occupancy rate, but it's quite a bit lower than its close peers, which shows that its portfolio quality has taken a hit in recent years. This is also very evident if you look at how its exposure to investment grade ready tenants has declined over the years. It used to be close to that of Agri Realty, today it's 2 times lower at just around 35%. Therefore, we have also previously argued that Realty Income should not be compared to Agri Realty and other high-quality net lease REITs anymore, and that it deserves to trade at a discounted valuation relative to them. And so unfortunately, with these latest results, the company has essentially reaffirmed what I already thought was true, and it is that its portfolio quality has degraded significantly following its many acquisitions of lower quality REITs, and the management even confirmed this on their latest conference call. Here's what they said. On the tenant side, our forecast includes a provision of 75 basis points of potential rent loss, as well as impact from the move out of a large office tenant. The majority of these impacts stem from the properties acquired through M&A transactions. So again, they confirm what I've been saying now for quite a while, and I've had a lot of you in the comment section tell me that I was wrong, that they were acquiring high quality properties through these M&A deals. But having followed this sector very closely for a very long time, I've always known that Spirit Realty Capital and VICI were lower quality REITs. They were typically priced at a steep discount relative to Realty Income, Agri Realty, and other net lease REITs, and there was a reason for this. They owned a lot of riskier, lower quality properties, which are now part of the portfolio of Realty Income. But to be clear, I'm not saying that this is the end of the world. Realty Income has an amazing management team. I'm sure that they will find solutions to these vacancies, potentially even release the space at higher rents to better tenants. They have a great track record, but this is yet another headwind for the company to deal with, and it will likely slow down its growth even further, especially relative to its other close peers. On that note, the REIT has started the year very conservatively, only increasing its dividend by 0.2%. So what's my overall rating for the company? Is it a buy, a hold, or sell at this time? And I think that depends entirely on what you're looking for. If you're a retiree, you need safe monthly income, then Realty Income is a buy at these levels. Its dividend growth will likely be slower in the coming years, but the dividend is safe and the dividend yield is historically high. Also, if like us, you think that interest rates will come back down in the coming years, then the REIT could enjoy additional upside on top of that. But if you're looking to maximize total returns, then I continue to think that there are better options in the net lease peer group. Some of its smaller peers own better portfolios, have stronger balance sheets, and enjoy far better growth prospects. And the difference in returns can be massive over the long run. I'll put a chart on the screen comparing the past 10-year returns from Agri Realty versus Realty Income, and you'll see there that Realty Income wasn't even close to Agri Realty. And the number one reason for this is that Agri Realty was able to grow faster, and I expect this faster growth to continue in the coming years. That doesn't mean that I'm much more bullish on Agri Realty today, because I think that has now reached its fair value already, but there are some other smaller net lease REITs today that remain very attractively priced despite enjoying better growth prospects, and therefore, since our capital is limited, we have no interest in buying Realty Income at this time. Finally, if you want to access my full REIT portfolio, you can join us for a 2-week free trial at High Yield Landlord. It will give you immediate access to my real money REIT portfolio, all my top picks for the coming years to maximize gains in the recovery. It's a completely free 2-week free trial, so you risk nothing to give it a try. You'll be the second link in the description of this video. Otherwise, thank you very much for watching this video till the end. If you could please click the like button, that will help me a lot to keep producing this type of content for you. Also subscribe to the channel. Thank you and see you at my next one. Bye bye.